Hey everyone, have you ever wondered how you can make the returns of, say, 10%, 15%, 20% in a day with it actually being possibly expected that you're going to make a profit? Well, that's what we're going to go over today with earnings trading. But instead of buying options around or and speculating about price fluctuations, we're going to sell options based off of qualitative data that we can analyze right here in-house. We're also going to be going over looking at the fundamentals, looking for when the market might be a little too weary or a little too overexcited, and how we can kind of guesstimate how that's going to shake out with the pricing of the options right now. So without further ado, guys, let's begin. Today's example is going to be on Cigna, ticker symbol CI. Now, what we can see here in the predicted alpha terminal are a couple of key metrics, and I'm going to come back to these. But first, we're going to go through what's going on with this company. And that is that they report earnings February 3rd for market open. So, a structure for this type of trade would be to sell options before the earnings event and take them off. So we would sell options the day before the close, just like you would buy options right before an earnings event. So in this case, you would sell Thursday afternoon, right, before the close and take it off Friday morning. Now, what are we seeing here? Well, the market is expecting, a beat year over year in terms of on a quarterly basis, a 1.5% increase. Analysts don't appear to be overly weary, but looking at another analysis of time series of what analysts estimated, we can see that Cigna usually beats. Right? That's like a consistent trend with them, but we're seeing that the estimated EPS is actually more in line in Q4 2021 and a substantial decline from what they've been doing in terms of earnings per share for the past 3 quarters. Now, a little backstory on this is mostly just due to cyclicality. They are an insurance company, after all, that basically just means that there might be payment systems that fluctuates over the course of the year and when the money comes in, etc. Nevertheless, the market doesn't appear to be overly weary. So let's go back and look at the quantitative data. We have an implied earnings move, aka how much the market expects the stock to move on the announcement of the event, which is 4%. Yet, Cigna only usually moves 3.16% on their earnings announcements. So the difference between the two is how we can make money. This is the expected value here, right? This is the premium. Because if we are selling at a 4% implied move and then buying it back after it only moves 3.1%, 1.6%, we're making that money every single time, day in, day out, day in, day out, day in, day out, right? It's the same way that you would sell volatility like we used in the example on Carvana. Now, let's continue. We can see that this max realized move here is 10.92%, right? That is the most that this has moved in the past recent quarters. That's a lot more than this, right? And it's affected the cumulative P&L. We want this number here to be negative. It's positive 85%. I'll get to why in a second. But straddle performance, this is basically saying if you bought a straddle every single quarter before the event and took it off after the event, this would be your P&L. So if you're buying straddles, 85%, we're arguing selling straddles and condors, then this isn't good. I'll get to why in a second, like I said earlier. Lastly, we have a couple more metrics here that are pretty important. Implied move versus average implied move. How much is the market implying for this earnings event on Cigna versus what it usually implies, right? And then again, implied versus average move. How much is the market implying versus usually what the stock does? And that is what we get paid for. Coming down here, we got some more tools. Some really interesting details that can really help you figure out what exactly this company usually does. What we can see is that there's really no determinant whether it's going to go up and down, but when it has a down move, it can be bad like this. When it applied 2.73%, it realized almost 11, right? Now, that one move killed the profitability on this trade. Forehand, this would have returned 86% between February of 2019 to May of 2021. So over 2 years, this would have been an 86% profit trade in terms of profits over those 2 years. That's a great backtest until then. But this is a great example of explaining when you get paid, why you get paid. Why do you get paid for this? Think about it. We're taking on this risk. We're selling the options here. We're getting a premium. Why are we getting the premium? In events like that. So that's the major risk that comes with these trades. However, it's also why they can be extremely profitable over time. Next, we have our implied earnings moves on a time series. So this is what the market's been implying for Cigna's earnings over time. It's relatively low. However, I'd like to argue that while that is nice to have higher implied moves to get filled at, this is what you get. This is how you make money. Implied versus realized. Not implied versus what the market usually implies. Next, we have our earnings moves distribution. This is the bell curve. This blue figure here is what it usually implies. So the higher on this bell curve, right, the more it's usually within that range. What we can see is that this is just slightly above its average. And this green hump is where it usually moves. So it usually is moving around 1.93%. However, there is skew, right? There are humps, tails. It's a big move here, southern move here. Remember, we get paid for that to hopefully happen. But the real reason that we get compensated is in the event of these. With that being said, now what's the trade? How do we capture this? How do we make money? Well, the last thing, guys, is this. In events like this, you're mostly going to want to sell straddles, right? You can do other things such as, condor, right? Where you can come in here and sell something like this. Oh, whoops. Sorry, guys. Let's just get rid of that. You can sell condors too, which are basically straddles, but, with a little bit of protection, right? Something like that. One sec. Let me come down like this. Don't know why it's like that. Sorry, guys. One moment. This is really. I've actually never seen this. This is really, really weird. Okay, there we go. Sorry about that, guys. I guess they have it listed as buy. I don't know. I usually never do condors. Also, this is a debit, which is really weird. So you know what? We're just gonna admit the condor. Anyway, the condor is like a wing and it's protection, and after hours is giving us some really funky numbers here. So let's just go back here and go through again on just the straddle because that actually was not completely messed up. So going back in and looking at the straddle, you're gonna notice a couple things. You're gonna notice that you get paid the most when it barely moves, right? When the stock does nothing. That's when we get paid, right? These are our break evens, right? On both sides. You're going to come to find that the break even on a straddle is just the P&L collected, right? It's the P&L collected. So if you sold this for $13.25, your break even is going to be $13.25 for the upside or upside and downside respectively. Now, what are these price slices here? Well, guys, this is its average move. You can price this out in Thinkorswim. So, in the event of Cigna, just realizing its relatively average move upon the earnings event, and implied volatility comes down because there's no more event taking place, we should expect P&L of around $290 to $330, right? In the event of a pancake, well, you can make a significant more amount of money. Now, I will say that this video is being recorded Thursday night, as in like in the morning. So, this is after hours data, and there's a whole nother day of trading to take place before the earnings event. So, it's going to be a little bit different than this. You're probably not going to be getting filled at a credit of you're probably not going to get filled at a credit of $13.25. It might be a little bit lower. Maybe not a lot though, because of the earnings event taking up so much of why these options are trading at these higher levels. So, when to position these trades again is in events where you think the event in itself is overpriced. That is when they make for great opportunities. So, guys, that is all I have for this one. If you have any questions, feel free to message me. And also, guys, if you have any names that you want us to take a look at and do a little analysis on, we'll be happy to do that as well. Just feel free to give us some feedback and we will go from there. So that is it for now, guys. Thanks and make it a great day.